Cash is one of the most important assets a business owns, and unfortunately, it's also one of the easiest assets to steal, misuse, or lose through error. That is why businesses need procedures in place to safeguard those funds. In this video, we'll discuss internal controls over cash and why they're so important regardless of the size of the business. You'll learn how businesses use internal controls to reduce the risk of theft, prevent errors, and make sure that cash transactions are recorded accurately. Many business transactions are now processed electronically, but the need for strong internal controls remains. In fact, as payment systems become more complex, effective controls become even more important. By the end of this lesson, you'll understand how internal controls help protect the company's assets, employees, and financial information. The fraud triangle explains the three conditions that are typically present when fraud occurs: pressure, rationalization, and opportunity. The first element is pressure. Pressure is the motivation that drives someone to commit fraud. Often this pressure is financial in nature, such as large personal debts, unexpected medical expenses, addiction problems, or maintaining an expensive lifestyle. Pressure can also come from unrealistic performance goals, bonuses tied to difficult targets, or major life events such as divorce, family problems, or fear of losing a job. When pressure becomes overwhelming, some individuals begin looking for shortcuts or quick solutions. The second element is rationalization. Rationalization allows otherwise honest people to justify unethical behavior by convincing themselves that what they're doing is acceptable. They may tell themselves, I deserve it, I'll pay it back, no one will get hurt, the company has enough money. Others may blame the company or their circumstances rather than accepting responsibility for their actions. These justifications help lower the person's ethical barriers and make fraud seem easier to commit. The third element is opportunity, which, in my opinion, is the most important component because it is the factor organizations can control most effectively. Opportunity exists when weaknesses in internal controls create a chance for someone to commit fraud without being detected. Examples include poor segregation of duties, inadequate oversight, management override of controls, weak monitoring procedures, or a lack of regular reviews and audits. While companies cannot always control an employee's personal pressures or rationalizations, they can reduce opportunities through strong internal controls. In fact, when opportunities are minimized through proper controls and oversight, the likelihood of fraud decreases significantly. Cash is often considered a business's most vulnerable asset because it's the most liquid asset the company owns. Unlike inventory or equipment, cash can be spent or stolen immediately, and once it is gone, it can be very difficult to recover. Because cash is so easy to access and transfer, businesses must establish controls over how cash is received, safeguarded, deposited, and recorded. Without these controls, errors can go undetected and opportunities for theft or fraud increase significantly. There are also hidden costs associated with handling physical cash. Businesses need additional security measures such as safe surveillance systems, armored card services, or procedures for making bank deposits. Many companies also purchase insurance coverage known as a fidelity bond to protect against losses caused by employee theft or dishonesty. Now, while digital payments can reduce some of the risks associated with handling physical cash, they introduce their own risks and require their own system of internal controls. Finally, internal controls do more than protect company assets. They also protect employees. Clear procedures, proper documentation, and accountability create a transparent record of transactions. This helps prevent misunderstandings, reduces suspicion, and protects honest employees from false accusations when discrepancies occur. Bottom line, it is simple because cash is both essential and highly vulnerable. Strong internal controls are necessary to protect the business, its employees, and its financial information. One of the most basic and most important internal controls over cash is requiring a receipt for every transaction. Every receipt creates a record of the sale and establishes how much cash the business should have received. This creates an audit trail that can be traced from the original transaction all the way to the accounting records and financial statements. The receipts are then used to record sales and cash collections in the accounting system. For example, a total sales receipt should ultimately be reflected as revenue on the income statement, and the related cash collection should be reflected in the company's cash balance. Without a receipt, there is no evidence that a transaction occurred. An employee could collect cash from a customer and simply keep the money without recording the sale. This type of fraud is often referred to as skimming because the cash is taken before it is ever recorded in the accounting records. That is why businesses regularly reconcile receipts, cash register totals, bank deposits, and accounting records. If the amounts do not agree, the discrepancy can be investigated. And requiring receipts and performing regular reconciliations makes it much more difficult for theft or errors to go undetected. Without a receipt system, a cashier could sell an item, not ring it up, and simply pocket the cash. That's why you sometimes see signs at restaurants that say, if you don't get a receipt, your meal is free. It's not just good customer service, it's a way to keep employees honest and accountable. Cash should never be sitting out in the open or be easily accessible. The cash drawer should only open when a transaction is entered into the register. This ensures that every time cash is handled, there is a corresponding entry, creating a trail that can be followed. Small changes like this significantly reduce the opportunity for theft. And that also applies to the petty cash drawer in the office. It should always be locked, and only one person should be responsible for opening the cash drawer and giving out cash for small expenses. At the end of each business day, the cash in the drawer is counted and compared to what the system says should be there. This daily check helps catch errors and identify suspicious activity early. If there's a difference, it needs to be investigated immediately before it becomes a pattern or ongoing issue. Companies also track cash variances by store location, time, and employee to understand where issues may exist. There may be simply a training issue or another more serious issue. A key principle of internal control is the separation of duties. The person who takes the deposit to the bank should not be the same person who records the deposit in the accounting system. The person who invoices sales should not be the person accepting or recording cash payments. This reduces the risk of someone misreporting or stealing funds without detection. Even in small businesses, finding ways to divide responsibilities is critical. If separation of duties is not possible, which happens in small businesses, there needs to be additional controls that detect theft, cameras in locations where cash is accepted, and strict review of all receipt and reconciliation against goods in inventory and sold. Many businesses also receive payments by mail, cash, or checks. In these cases, internal controls are even more important. Ideally, the person who opens the mail and handles the deposits should not be the one recording and posting payments to customer accounts. If at all possible, the remittance advice, which tells us what the payment is for, should go to accounting, while the cash or check goes to someone else. This helps prevent misappropriation and ensures customer accounts are properly updated. At least once a month, preferably more often, the business should reconcile the cash ledger to the bank statement. This means that what the books say matches what actually got recorded by the bank. Any discrepancies should be reviewed and resolved, and they might point to errors, delays, or even fraud. Regular reconciliations help maintain accurate financial records. Let's summarize what we've learned. Always issue receipts for every cash transaction, keep cash locked, and only open the drawer for legitimate sales. Use separation of duties. No one person should control an entire transaction from start to finish. For payments received by mail, split responsibilities between handling and recording. Perform bank reconciliations regularly to ensure your records are accurate and complete. Remember, good controls aren't just about preventing theft, they also build accountability, accuracy, and confidence in your financial systems. Fraud typically occurs when pressure, opportunity, and rationalization come together. While businesses cannot always control an employee's personal pressure or rationalizations, they can significantly reduce opportunities through strong internal controls. By implementing procedures such as segregation of duties, proper authorization, independent verification, and regular reconciliations, organizations can better protect their cash and strengthen trust in their financial information.